Now we're going to talk about financial statements. Those are those reports that are done at the end of any given period for a business. And the first one we're going to talk about is always the first one that's compiled, and that's called an income statement. An income statement. Based on that name, I bet you can guess what goes on an income statement. Income, which for the purposes of a business would be some type of revenue. So, an income statement is going to report the profitability of a business. So it's going to take into account the revenue and subtract any expenses associated with the operation of that business. Now, if expenses are less than revenue, what does that mean? Profit. And if expenses are more than revenue, what does that mean? Loss, called a net loss. So based on your revenue and expenses, you determine whether you have a profit or a loss. And again, this financial statement is called the income statement. It can be called a P&L statement or a profit and loss statement or things similar to that. But oftentimes it's called an income statement. So I'm going to show you what it actually looks like, and we're going to just look through a simple one. But you won't have to do one yet, but you will do one here in a couple weeks. So let's look at one. Okay, first of all, take a look at the heading on this, because the heading is a 3-line heading and it must be on all financial statements. And it begins always with the same thing, company name. So whatever is the name of your company, that goes at the top. It's then followed by the name of the financial statement that you're doing. In this case, it is income statement. Now, the third line is one you need to remember. It is the period that the income statement is for. Now, that period could be a week, could be a month, could be a quarter, could be a year, or anything in between. But it will reflect what it is in that third line of the heading. So if this was for a month, what would that say? For month ending, let's say June 30th, 2011. And by the way, when you see an X in the year in your book, do not put an X on your papers. What does that mean? When you say 200X, yes, it means fill in the correct year or the current year with the X. So don't put the X's in. That isn't truly a year, unless you're using Roman numerals. Okay. Income statements always start with revenue. And since we're going to be starting with service businesses, a typical name for maybe a revenue account for a service business would be delivery fees. And how much did we make for this period? $5,000. Now, from that, we must subtract all operating expenses associated with that revenue. And you're going to list all of those expenses. There's only a couple showing here, but typically you'd have far more. So let's see. Salaries expense, $1,000. Rent expense, $2,000. The total of both of those is your total operating expenses. Or how much? $3,000. Why did I move it all the way over underneath that total revenue? Because you're going to do a computation. You're going to take the $3,000 in total operating expenses and subtract it from that delivery fees And the end result is net income. What if that had been reversed? What if my total operating expenses had been $5,000 and my delivery fees had been $3,000? What would I say down here? Net loss. So you need to identify what it is at the bottom. If it's income, reflect it as income. If it's loss, reflect it as loss. Well, loss indicates a negative, but I see why you're wanting to put a negative there. Because for all purposes, it is a negative number. Okay, any questions on the income statement? Not yet. Close your eyes. Could you do it? Yes. Question?
Oh, just, the 2 lines and the 1 line.
You don't have to worry about it. Typically, the forms you're going to get are going to be 2 columns now, but if you can just come to this, I'm okay with that. All right? Now, anybody remember which financial statement comes after the income statement? Good. Statement of owner's equity. So let's take a look at that. First of all, what is a statement of owner's equity? It updates your capital account that you began with for this specific period of time and includes anything that has impacted that beginning capital. And remember those items that affect capital? What were they? Withdrawals, good. Expenses and revenue. One that we have talked about, but we didn't put on last time, was investments. Investments will also impact capital. Remember, if you invest more money in the business, what happens to your owner's equity or capital account? It goes up. Okay, so a statement of owner's equity reports the activities that affected that capital account during a specific period of time. The reason it's done after the income statement is that net income that we determined on the income statement gets brought over to the statement of owner's equity. So we have to know that amount before we can do this update to our capital account. Okay, questions on that? We're going to take a look at a statement of owner's equity, which is one of our shortest financial statements. Okay, here's another example, and notice the heading. Very similar to the last one. Company name on the first line, the name of the financial report on the second, statement of owner's equity, and the third line again includes the period of time this is for. If it's a month ended, you'd put for month ended June 30th, 2011. If it's for a quarter ended, you'd put for quarter ended March 31st, 2011, etc. Now, it starts with the owner's capital account at the beginning of whatever period of time that was. So if this is for the month of June, what would the date be on that first line? June 1st. And the amount in that capital account is $10,000. Now, net income for a month, where did you see that? On the income statement. So that gets brought over to this financial statement and gets plugged in right there, net income for a month. From that net income, you're going to subtract any withdrawals that the owner made during that month. What if there aren't any? You don't put anything here, just leave this line off. But if there are any, you put that down and then you subtract it from your income to get either an increase in capital or a decrease. If they withdraw more than you make, obviously your capital is going down. But this happens to be 2,000 minus 1,000 is 1,000. So capital is going to go up by 1,000. And if it goes up by 1,000, what is our ending capital balance? 11,000. And what date would we put here? Good, June 30th, or the ending date from the heading. Okay? One more thing let's talk about before we go on to the last one, and that is, what if I had additional investments during the month of June? Where would that go? Or probably above it. Usually investments are done before net income, but you could put it. So you'd put plus additional investment. And is that going to make capital go up? Yes. Okay, any questions on this one? This one seems to make more logical sense than any of the others for new people learning it. Okay, one more.
I have a quick question. For the additional
Want to pause it?
investment, it only goes on this statement?
Okay. The last financial statement you're going to compile is called the balance sheet. Called this because the balance sheet must balance the accounting equation. So, what was the left side of the accounting equation? Assets. So assets must balance or equal the liabilities total combined with the capital total. So the balance sheet again must balance. If you get to your balance sheet and it's not balancing, what is that telling you? Something has been done wrong. Okay, so let's show you an example of a balance sheet. Now this is one format for a balance sheet. It is not the only format. This is a double column one. You can do it in simply one column all the way down, just listing your liabilities and capital underneath your assets. You still need to balance the same way, but it's just listed differently. And when we get to later in the term, we'll do it in the one column format versus the two. But for now, this one makes sense because this is the left side and that is the right side. And it's easier to learn it this way. So first of all, for the balance sheet, notice the heading. First two lines, just like the other financial statements, just change the name of the financial statement to balance sheet. But the third line's different. It's not for a period of time, it's as of a specific date. A balance sheet's considered a snapshot of the financial condition of a business at any given day or time. So this is not again for a period of time. It's as of June 30th, this is the financial condition of our business. Question?
It doesn't look like it balances. Accounts payable is 1,000 and earned equity is 11.
It
Wouldn't the
isn't.
result be 12 grand?
It isn't imbalance, is it? So what's wrong here? Over here on the right, they're supposed to balance, correct? So do they balance? No, because what is 1,000 in liability and 11,000 in capital? 12,000. So that total liability and owner's equity showing there is incorrect. Can this be a true snapshot of this business? based on what you've learned so far? No, because what does it require on a balance sheet? That your assets equal. Now, the first thing you could do is say, okay, maybe we just computed incorrectly here. Is the capital correct? How do you know that?
We have to go back into the other statement.
Statement of owner's equity. Remember what it was at the end of it? Was it 11? Yes. So let's assume that that's right, and if we have any kind of accounts payable, looks like the incorrect amount is down here, correct? So this should be 12,000. Now, check the addition here. Tell me what you find. Right, wrong. So, can this be an accurate snapshot of our business?
No.
So, what does that mean if the right side is correct? We've made an error with one of these. So we're going to have to go back to our records to see where that error occurred. So, based on that, why do we do a balance sheet? Because there's numerous reasons we do a balance sheet. What's one of them? Maybe somebody wants to see the financial condition of your business, and this will reflect it. Another reason is to check for accuracy. Obviously, if this doesn't balance, what's that telling us? There's an error somewhere, and this is the best time to fix it before it keeps going on. Okay? But a balance sheet equals the left side, your assets, the right side, your liabilities and owner's equity. Could there be more than one liability account listed? Yes. We only happen to have one there, in which case you'd have to add those up.